Welcome to this episode of The Third Empire. My name is Raj Mehta. Now, all of us here at Informed Investor are looking to add value to your lives by providing market insights on a daily and weekly basis in the form of recorded videos, live webinars, and also by conducting in-person workshops. Now, in our quest to become more and more relevant, we seek your inputs in terms of the various topics that you would like us to discuss and create videos on so as to help you better. So we urge you to drop your suggestions on the topics that you would like us to cover in the comment section below, and we will put in our best efforts to cover them in our forthcoming episodes. Moving on with today's episode, at some point in our lives, all of us have at least once gotten a health checkup done. Now, the whole point of a health checkup is to understand whether everything is A-OK within the system. Now, the checkups are recommended to be done regularly so as to help identify any early signs of health issues and to maximize the chances of an effective treatment, as several factors such as age, health, family history, and lifestyle choices have a bearing on it. Just like our bodies, the financial system of the economy also needs to be checked regularly to identify any early signs of possible threats and eliminate them in a timely manner to avoid any level of financial distress within the economy. Now, the RBI does this twice in a year and publishes a report known as the Financial Stability Report. Now, the reports of the latest tests were released recently, and we will discuss a few important highlights of this report which helps assess the overall stability of our financial system. While we do that, we will also discuss the updates from the first advanced GDP estimates which have been released by the Statistics Ministry for FY23. We will also discuss the World Bank's projections for the Indian economy as it flags major slowdown concerns globally. You're watching Informed Investor, the Third Empire, an initiative by ResearchAndRanking. Let's begin. Recently, the Reserve Bank of India released the 26th edition of the Financial Stability Report that assesses the overall stability of the Indian financial system. Now, the report is issued by RBI's Department of Economic and Policy Research and is released semi-annually. Now, the Financial Stability Report provides an assessment of the vulnerabilities in the financial system and an analysis of the various risks that could impact the stability of the system. Now, it also provides an overview of the various policies and measures that have been put in place to address these risks and vulnerabilities. Now, the report is intended to inform policy makers, regulators, market participants, and the general public about the risks and vulnerabilities in the financial system and the measures that are being taken to address them. Now, the report plays an important role in maintaining financial stability by providing an early warning of potential risks and vulnerabilities, as these allow regulators to take preventive actions before it creates a systematic problem. This is especially important in emerging economies like that of ours, where the financial system is in the developing stage. Now, in common parlance, the Financial Stability Report is like a regular health check report of the financial system. While the economy is facing global headwinds, macroeconomic fundamentals and healthy balance sheets provide strength to the financial system. Capital positions of banks were strong in September 2022. The GNPAs fell from 5.9% in March 2022 to 5.7% in June 2022 to 5% in September 2022, as against 9.3% seen in September 2019, facilitating broad-based expansion in the bank's credit. Now, net non-performing assets have dropped to a 10-year low of 1.3% of the total assets. The lower fresh additions to NPAs have been a major contributor to this factor. Now, macro stress tests show that banks are well capitalized and capable of absorbing macroeconomic shocks even under adverse stress situations. Now, a stress test measures the bank's ability to withstand extreme but likely stress situations. A macro stress test evaluates how well commercial banks will be able to withstand shocks to interest rates, credits, and liquidity. Now, a baseline scenario and two bad scenarios, medium and severe are used by the RBI to evaluate the capital ratios over a 1-year period. Now, it helps in decision making, particularly when considering various courses of action, including risk mitigation strategies, backup plans, and capital and liquidity management. And it also helps top bank management foresee the bank's condition during challenging times. Now, stress tests indicate that the GNPA ratio of all commercial banks may improve from the 5% in September 2022 to 4.9% in September 2023 under the baseline scenario. Now, the banking industry is in great shape after years of distress. The RBI stress tests demonstrated that banks would meet the minimal capital requirements even in the extreme stress situations. Although writing off bad loans has contributed to the fall in the NPAs, the industry is no longer a source of financial stress. While we say this, the banking system is at its best in almost a decade. For the current credit cycle to be sustained, banks must not repeat the mistakes of the last one. Now, the improved asset quality, return to profitability, and the robust capital and liquidity buffers of banks were contributing to the strong demand for bank loans, and early indicators of a rebound is in the investment cycle as well. Now, after talking about the resilience of the banking system, the central bank has been emphasizing the threats that fintech and big tech companies represent to the financial system. The RBI had recommended in the report that the financial system needs to be protected against the possible volatility that the fintech sector could bring about. Now, the report also discusses the health of the economy as a whole. Now, after being above the upper tolerance level since January, India's retail inflation has reduced and front-loaded monetary policy moves are anticipated to further reduce it. Now, the report also mentioned the possibility of a future pressure due to the durability and broadening of core inflation. Now, having said that, the external accounts have been an area of concern. Now, in this regard, the SBI stated that the current account deficit increased to 4.4% of the GDP in the second quarter from 2.2% in the first. Now, the growth in its merchandise trade deficit was primarily responsible for the current account deficit. Additionally, capital flows fell short of what was needed, which caused a $30 billion decline in the foreign exchange reserves. However, there has been a rebound in the reserves over the current quarter. Despite the current account deficit rising to unsettling heights in the second quarter, experts anticipate a significant decline. The current account deficit is anticipated to be less than the levels predicted just a few months ago at roughly 3% of GDP for this fiscal year. However, the policymakers would need to be on guard in case of any uninvited surprises. Now, the report also highlighted some of the key initiatives taken to combat COVID and their resultant effect on the financial sector and the economy as a whole. The Emergency Credit Line Guarantee Scheme was launched in May 2020 as part of the Atmanirbhar Bharat Abhiyan to support eligible micro, small and medium enterprises and other businesses in recovering post-COVID. Now, the banks were provided with a complete credit guarantee for loans given by them under the scheme to eligible MSMEs. Now, the admissible guarantee limit under the scheme was increased from Rs 4.5 lakh crores to Rs 5 lakh crores earlier last year, with the additional guarantee cover of Rs 50,000 crores earmarked exclusively for the hospitality and the related enterprises, including the civil aviation sector. Now, 1/6 or at least 16.66% of the total loan accounts which raised credit under the Emergency Credit Line Guarantee Scheme have turned non-performing assets or NPAs as of September 2022. Now, the position of the Emergency Credit Line Guarantee Scheme lending indicates that the distress continues in the MSME sector and policymakers need to look at newer ways to help this sector in particular. The next financial catastrophe could result from allowing private cryptocurrency to expand, according to Governor Shri Shaktikanta Das Ji. Similar to this, and in contradiction of its claims of inflation hedging advantages, the value of crypto tokens declined as inflation increased. Now, the report made clear that a consistent regulatory approach, particularly at a global level, is necessary given the volatility of such currencies and potential risk of spillovers into the conventional financial system. Now, the research claims that the ongoing instability in the cryptocurrencies market caused by the bankruptcy and collapse of the cryptocurrency exchange FTX and the following sell-off in the market for crypto assets has brought to light the system's fundamental flaws. Recently, Binance, the largest crypto exchange, has also prohibited withdrawals of stable coins on its platform. Before FTX collapsed, Terra USD, Luna, an algorithmic stablecoin, Celsius, a cryptocurrency lender, and the Three Arrows Capital, a cryptocurrency hedge fund, had also failed. Now, a unified worldwide strategy is required to prevent the volatility of cryptocurrencies and their catastrophic breakdowns from affecting the conventional financial system, according to the report. Now, working on a global crypto framework will continue to be a top priority under India's G20 leadership to prevent financial turmoil. Now, India is a country that relies heavily on agriculture. More than 60% of the people in our country rely on agriculture for a living. The Indian farmer is burdened with debt despite this. The Kisan credit card program was established in 1998 to provide farmers with credit cards that they could use to easily buy agricultural inputs like seeds, fertilizers, insecticides, and other items, as well as withdraw cash for their production needs. Now, due to the difficulties associated with rural lending in India, the RBI had suggested moving towards digitization of the Kisan credit card scheme in the report. Now, the Reserve Bank's Innovation Hub is creating the pilot project to completely digitize the Kisan credit card financing. By automating and enabling end-to-end digitization of the key processes such as the automation of the bank's loan origination system and its integration with the state government's land record database through application program interfaces, this move will aim to significantly reduce the turnaround time of Kisan credit card applications. This will enable the real-time verification of the land records data as well. By making the credit procedure quicker and more effective, the pilot project on digitizing the Kisan credit card lending is anticipated to play a crucial role in facilitating credit flow to the underprivileged and the unserved rural people. Now, this is anticipated to change the nation's rural credit delivery system when completely implemented. Now, we all know that there are significant economic headwinds which have affected the world, and there are significant recessionary risks as well. Multiple events combining have tightened financial conditions and increased volatility in the financial markets. Now, the difficulties are much more severe for emerging economies as they deal with global spillovers, debit fragility, currency volatility, and capital outflows. Now, significant global headwinds are affecting the Indian economy as well. However, stable financial systems are being created by strong macroeconomic fundamentals, strong balance sheets in the financial as well as the non-financial sector, and other factors. Despite being high, the inflation is declining as a result of the supply-side initiatives and the front-loaded monetary policy moves. Now, the financial industry is benefiting from improved asset quality, a return to profitability, and robust capital and liquidity buffers, which are driving up demand for bank loans and showing early signs of a rebound in the investment cycle. Now, due to these capabilities, the financial system is better able to withstand external spillovers, tightening global financial conditions, and the excessive market volatility. The Financial Stability Report has outlined the key risks in all of these aspects, and the policymakers will take them into consideration to mitigate any risks which could severely impact the financial system going forward. The first advanced estimates of the GDP introduced in 2016-17 to serve an essential input to the budget exercise is based on limited data and compiled using the benchmark indicator method, that is the estimates available for the previous year, which is 2021-2022 in this case, and are extrapolated using relevant indicators reflecting the performance of sectors. Now, the figures assume significance as they come ahead of the presentation of the general budget in the Lok Sabha on the 1st of February 2023. The National Statistics Office provides as many as 6 iterations of its estimates of the annual size of the Indian economy for any single year. These numbers are released over a period of 36 months. Now, a comparison between the first and final iteration of the GDP numbers for the same year brings out significant variations. Now, in some years, the variation reflects an overestimating made in the first print, while in others, there is an underestimation. Last year, the first advanced estimates pegged the GDP growth for FY 2022 at 9.2%, and the second advance estimate revised it downward to 8.9%. Likewise, FY21 growth was revised downward to -8% in the second advance estimate from -7.7% in the first advance estimate. Now, the Indian economy since then has come out of the pandemic in a far better shape than most other large economies as well as some of our neighbors. Now, growth is higher, inflation is lower, and the debt levels are more manageable. Most of the high-frequency data for December points to a broad-based recovery in the economic activity. India has also managed to avoid the crises that have hit our neighbors such as Pakistan or Sri Lanka. India's gross domestic product may grow by 7% for the fiscal year 2022-2023 according to the first advance estimates released by the government. India's GDP had grown at 8.7% in the year ending March 31st, 2022. Now, this is 20 basis points higher than the Reserve Bank of India's estimates and the International Monetary Fund's estimate of 6.8% growth in the GDP. India's economic growth forecast by economists, investors, and multilateral agencies in FY23 is anywhere in the range of 6.5% to 7%. India's nominal GDP growth for FY23 is estimated to grow at 15.4% as against 19.5% in FY 2022. Nominal GDP, as we all know, is the GDP net of the effect of inflation. Gross fixed capital formation growth has remained strong, driven by the government's focus on infrastructure development. But for sustainable growth and recovery of the Indian economy, a revival of the private corporate sector capex is a must. Unfortunately, private corporate investment, with the exception of a few sectors, is not going beyond the maintenance capex because consumption demand is still not broad-based and the economy has yet not gathered its own momentum. We also see a difference between the first and the second half private final consumption expenditure growth numbers of FY23, which suggests that consumption demand has yet not become broad-based and sustainable. While car sales numbers suggest a strong demand revival, FMCG sales points towards a very weak demand. This is indicative of the nature of the evolving consumption demand in the post-pandemic period, which is highly skewed and is in favor of goods and services consumed largely by the households falling in the upper income bracket. Now, the output of the manufacturing sector is estimated to be decelerated to 1.6% as against a growth of 9.9% in FY 2022, while construction growth may moderate to 9% in FY 2023 from 11.5% seen in the last fiscal. Similarly, mining sector growth is estimated to slow down to 2.4% in the current fiscal as against 11.5% seen in FY 2022. Overall, the growth momentum witnessed in FY 2023, despite the global headwinds, is good news and shows that the resilience of the Indian economy stands. However, the road ahead is not going to be so easy so long as private final consumption expenditure does not recover fully and becomes broad-based. Now, post-pandemic normalization in economic activities, coupled with the higher pent-up demand and capex boost by the government, supported growth. Manufacturing sector could benefit from the moderation in the commodity prices but will feel the pain of lower external demand. On the domestic front, the expectation of easing inflation levels and the good Rabi output will be supportive of domestic demand. However, challenges are looming on the external front due to slowing global demand and tighter monetary policy. Now, the World Bank projections for India's GDP growth in 2023, as per its Global Economic Prospects report, concur with the advance estimates as well. The Indian economy is projected to grow at a rate of 6.9% in FY23 as per the World Bank's report. Now, this is a 60 basis point downward revision in the World Bank's estimates since the first estimates for the fiscal released in June, as the global economy and the rising uncertainty will weigh on exports and investment growth. Now, the World Bank highlighted that India is expected to be the fastest growing economy of the 7 largest developing economies. The bank stated that government's increased infrastructure spending and the various business facilitation measures, however, will crowd in private investment and support the expansion of the manufacturing capacity. Now, this comes at a time when the global growth is slowing sharply in the face of elevated inflation, higher interest rates, reduced investments, and disruptions caused by Russia's invasion of Ukraine. So, the global economy is projected to grow by 1.7% in 2023 and 2.7% in 2024. Now, the sharp downturn in growth is expected to be widespread, with forecasts in 2023 revised down for 95% of the advanced economies and nearly 70% of the emerging economies and developing economies. Now, given fragile economic conditions, any new adverse developments such as higher than expected inflation, abrupt rises in interest rates to contain it, a resurgence of the COVID-19 pandemic, or escalating geopolitical tensions could push the global economy into a recession. That being said, India continues to remain the beacon of growth and stability amidst testing global conditions. With that, I conclude today's episode. But before I go, I would once again urge you to drop your suggestions in the comment section below for us to be able to cover more and more topics which you find relevant. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.